Welcome, deep divers. Ever wondered what's really going on behind the scenes when a big company makes a decision?
Yeah, how do they really know what things cost? Or if they're actually doing well?
Exactly, or how they plan for the future, strategically. Well, today we're pulling back the curtain on that hidden financial world, the engine room of every successful organization.
It really is. It's where raw numbers get turned into strategic gold. It helps businesses not just survive, but actually innovate and, well, thrive. It's like understanding the company's heartbeat.
Totally. And our mission today for you is to give you a shortcut to understanding that pulse. We're going to untangle the core ideas behind how businesses track costs, measure performance, how they budget, forecast.
And analyze their financial health.
Right. We've got a great stack of sources here, and we're ready to pull out those crucial nuggets, make it all easy to grasp. So let's dive in.
The building blocks of business costs.
Okay, let's unpack this. When a company makes something, anything, or provides a service, how do they even start tracking the real cost?
Well, it all begins with something called cost objects.
Cost objects, right. So what are those exactly?
Think of them like specific targets for cost measurement. You need to know the cost of something specific for decision making.
Okay, so like a single product.
Could be a product, yeah. Or a whole product line, maybe a department, or even like a geographic sales territory.
Yeah.
The point is getting a precise handle on spending tied to that specific thing.
Got it. So once you have your target, your cost object, what's next?
Then we generally sort costs into two main buckets, product costs and period costs.
Okay, product versus period. Let's start with product costs.
Sure, product costs are directly linked to actually making a product.
So the stuff that goes into it.
Exactly. Direct materials, the direct labor involved, and also what we call applied overhead, manufacturing overhead.
And these costs, they actually become part of the inventory.
That's the key thing. They sit on the balance sheet as an asset until that product is sold.
Ah, so they flow through, like from raw material.
So work in process, then finished goods inventory.
And then they finally hit the income statement as cost of goods sold when the item ships out.
Precisely.
Okay, so that's product costs. What about period costs?
Period costs are, well, different. They're non-manufacturing expenses.
Like sales commissions? Or
Yeah,
the CEO's salary?
exactly. Selling costs, general administrative costs, they get expensed on the income statement in the period they happen, no matter when products are actually sold. They're just part of running the business for that specific period.
Okay, clear distinction. Product costs follow the product. Period costs hit the books right away.
You got it.
So, next step. How traceable are these costs? Does that matter?
Oh, absolutely. This brings us to direct costs versus indirect costs.
All right, direct costs first. Sounds straightforward.
It generally is. Direct costs are easily traced to a specific cost object. You don't need a lot of effort or, complex calculations.
Give me an example, like Spud Furnishings making custom couches.
Perfect. The fabric or leather they use for one specific couch, that's a direct raw material. And the time the upholsterer spends actually building that couch, that's direct labor. It's clearly tied to that single cost object to the couch.
Makes sense. So indirect costs must be the opposite.
Pretty much. They're often lumped into manufacturing overhead.
Mm-hmm.
These aren't easily traced to just one product or service
Why not?
because they benefit lots of different products or operations simultaneously.
Mm.
Think about Spud Furnishings again. The cleaning supplies for the factory.
Right. Can't assign that to one couch?
Or the lubricant for the machines. That's indirect materials. Then you have indirect labor. The forklift drivers moving stuff around, the factory
They
supervisors.
support everything, not one specific job.
Exactly. And then there are other indirect costs. Depreciation on the factory building, the rent, utilities for the whole plant.
All the essential stuff that keeps the factory running but isn't tied to a single couch.
You nailed it.
So accountants have terms for combinations of these, right? I think I saw
Um,
prime costs.
Yep. Prime costs are just your direct materials plus your direct labor,
Mm.
the sort of primary core costs of making something.
And conversion costs.
That's your direct labor plus that manufacturing overhead. It represents the cost of, well, converting the raw materials into the finished product.
Okay, prime and conversion. Got it.
What's really insightful here, though, is that these distinctions aren't just for the accounting nerds. They fundamentally shape how managers think.
How so?
Well, knowing if a cost is direct or indirect helps a manager understand what they can actually control or influence directly versus costs that are spread out. And this immediately raises a really important question.
Which is,
How do these costs behave when production levels change? Do they stay flat or do they move up and down with activity?
Excellent question. That takes us straight into cost behavior. How costs react to changes in activity, usually volume. Let's start with fixed costs.
Okay. Fixed costs. The name kind of gives it away, right?
Mostly, their total amount doesn't change, but only within a certain relevant range of activity. Think of factory rent.
Right. Whether you make one couch or 1,000 this month, the total rent bill stays the same.
Exactly. But here's the clever bit, or maybe the tricky bit.
Uh-oh.
While the total amount is constant, the fixed cost per unit actually changes.
Ah, because you're spreading that same total cost over more or fewer units.
Precisely. Make more couches, the rent cost per couch goes down. Make fewer, it goes up. This is a classic exam trick, by the way.
How so?
They'll give you a fixed cost per unit at a specific volume. You have to remember to convert it back to the total fixed amount first, because that total is what stays constant as volume changes within that range.
Good tip. So fixed in the short term within the relevant range.
Right. But eventually, almost any cost can become variable in the long run. If Spud Furnishings needs a whole new factory to double production.
Then that new factory's depreciation suddenly looks a lot more like a variable cost tied to that growth.
Exactly. Okay, so the opposite of fixed costs must be.
Variable costs.
And these ones do change.
Yes, the total variable cost changes directly and proportionally with the cost driver, like production volume.
So make twice as many couches.
Your total direct material cost will roughly double, assuming the price per yard of fabric stays the same.
But the cost per unit.
Ah, that's the opposite twist. The variable cost per unit stays constant. The fabric for each couch costs Spud Furnishings the same amount per couch, no matter how many they make.
Okay, so fixed. Total constant per unit varies. Variable. Total varies per unit constant. Within the relevant range.
You got it.
Is that it? Fixed and variable.
Well, there's one more to keep things interesting. Mixed costs, sometimes called semi-variable.
A mix of both.
Exactly. They have both a fixed component and a variable component. Imagine Quality Ornaments, Inc., their machine maintenance cost.
How would that be mixed?
They might pay a fixed fee each month for scheduled preventative maintenance. That's fixed. But then, if machines break down more often during high production, they pay an extra variable charge per repair hour.
Ah, so a base fixed amount plus a variable part that changes with usage. Got it.
And all this discussion of fixed, variable, mixed, it all depends on that concept we mentioned, the relevant range.
Right, explain that again quickly.
It's simply the range of activity, say production volume, where our assumptions about cost behavior hold true, where we assume costs are linear, that fixed costs really are fixed, and variable costs per unit are constant.
And if you go outside that range,
Then those assumptions might break down. You might need more factory space, bumping up fixed costs, or get volume discounts on materials, changing variable costs per unit. The relationships might change.
advanced costing strategies and allocation.
Okay, so we've got types of costs, how they behave. But how do companies actually apply these costs to their products? Especially when things get complicated, like, making custom things versus mass-producing identical items.
Right. This is where it gets really interesting because modern costing systems aren't just about adding up costs. They're tailored to how a company produces things.
So different systems for different situations.
Exactly. We generally talk about two main cost accumulation systems. First up is job order costing.
Job order. Sounds like it's for specific jobs.
Precisely. It's ideal for unique custom orders or distinct batches. Think custom home builders, aircraft manufacturers.
Or Spud Furnishings and their custom couches.
Perfect example. With job order costing, every single cost, materials, labor, a share of overhead, is meticulously tracked for each individual job. They use things like job cost records, materials requisitions, labor time tickets. It's all about assigning costs to one specific identifiable order or batch.
Okay, so that's for unique stuff. What about things made in huge quantities?
For that, we use process costing. This is for mass-produced, homogeneous items. Think steel, chemicals.
Like those fruit pies from Fresh Baked Company.
Exactly. Millions of identical pies. Instead of tracking costs per pie, which would be impossible, process costing averages costs across huge numbers of units as they flow through different production departments or processes.
Averaging costs. But what if some units aren't finished at the end of the month?
That's the key challenge in process costing. We have to deal with equivalent units.
Equivalent units. Sounds complicated.
It's just a way to handle partially completed units. If you have 100 pies that are only 50% complete in terms of labor and overhead at month end, you treat them as being equivalent to 50 fully completed pies for costing purposes. It lets you accurately spread the costs incurred during the period over all the work done, both completed and partially completed units.
Okay, so it's a way to account for work in progress.
Exactly. And there are different ways to calculate those equivalent units, like FIFO, first in, first out, or weighted average.
Briefly, what's the difference there?
Well, without diving too deep into the math conceptually, FIFO tries to separate the costs of completing beginning inventory from the costs of units started and completed this period. It uses current period costs for current period work.
Okay, and weighted average.
Weighted average sort of blends everything together. It averages the costs in beginning work in process inventory with the costs added this period and applies that average cost to all units completed and those still in ending work in process. It's a bit simpler calculation-wise, usually.
Got it. Two ways to smooth out the costs over units.
Right. Now, something else happens in production sometimes. Spoilage.
Oh yeah, things go wrong. How is that handled cost-wise?
It depends. We distinguish between normal spoilage and abnormal spoilage.
Normal spoilage sounds like expected waste.
Exactly. It's the kind of spoilage or shrinkage that happens under regular, efficient operating conditions. You expect some level of it. The cost of this normal spoilage is actually considered a product cost.
So it gets included in the cost of the good units.
Yes. Essentially, the good units that make it through have to absorb the cost of the units that normally spoil. This means the per unit cost of the good units goes up slightly.
Okay, what about abnormal spoilage?
That's different. This is spoilage that shouldn't happen under normal conditions. Maybe a machine breaks down unexpectedly or there's a big operator error.
This is not expected.
Right. And because it's considered avoidable, its cost is treated as a period expense. It hits the income statement directly in the period it occurs, almost like a loss. It doesn't get attached to the good units produced.
Highlighting that it was an unusual, costly event.
Precisely.
Okay, that's a really useful distinction. So we have job order for unique, process for mass production, ways to handle spoilage. But what about those indirect costs again? The overhead. You mentioned applied overhead earlier.
Yeah.
How do companies get that right, especially when a simple allocation might distort things?
Ah, yes. This raises a really crucial question. Traditional costing systems often just use one single measure, like a direct labor hours or machine hours, to allocate all factory overhead costs to products.
What's wrong with that? Seems simple.
It's simple, but it can seriously distort product costs, especially today with automation and complex products. Think about it. Does a product that requires complex machine setups really consume overhead in the same proportion to its direct labor hours as a simple product that just needs assembly?
Probably not. The setup is a different kind of overhead driver.
Exactly. This is where activity-based costing, or ABC, comes in. It's a more refined approach.
Activity-based, so it looks at activities.
Yes. ABC assigns indirect costs based on how much different products demand various resource-consuming activities. It recognizes that different activities drive costs, not just production volume.
So it uses multiple causes and effects.
Right, it's more detailed. We define an activity as any work performed, like setting up a machine, inspecting parts, processing an order. A resource is what's needed for the activity, like people or equipment. A cost driver is what causes the cost of that activity to happen, like the number of machine setups or the number of inspections.
Okay, so you identify activities, their costs, and what drives those costs.
Correct. You accumulate costs into cost pools linked to specific activities or activity centers. Then instead of one overhead rate, you calculate multiple rates, one for each activity pool based on its cost driver.
Like at Hope Hospital example.
Yeah.
Patient registration costs driven by number of registrations.
Exactly. Then you trace those activity costs to products based on how much each product uses those specific activities.
So a product needing lots of complex setups gets allocated more setup cost.
Precisely. Even if it doesn't use many direct labor hours. ABC assigns higher overhead to products that place heavy demands on expensive resources, regardless of volume, and less to simpler products. It removes a lot of the cost distortion you get with traditional methods.
That Iowa products example was striking. How the bottle products cost jumped under ABC.
Yeah, because traditionally, both can and bottle got the same overhead per unit based on volume. But ABC revealed that bottle used way more expensive product redesign resources, which wasn't volume related. ABC correctly assigned those costs, showing its true higher cost. That changes everything for pricing and profitability analysis.
It makes total sense. More accurate costing.
And we can apply similar ABC principles to allocating service department costs.
Like IT, HR, accounting. Costs that support production but aren't production themselves.
Exactly. How do we get those costs fairly allocated to the production departments they serve and ultimately to the products? There are a couple of methods. The direct method is the simplest. It just allocates each service department's costs directly to the production departments. It completely ignores any services that service departments might provide to each other.
So IT costs go straight to assembly and finishing, even if HR uses IT services.
Right. It's quick, but maybe not the most accurate if there are significant inter-service department activities.
What's the alternative?
The step-down method or sequential method.
Yeah.
This one is more sophisticated. It allocates service department costs in a specific sequence, first to other service departments and to production departments.
So it recognizes that HR might support IT.
Yes. For instance, you might allocate HR costs first to IT and assembly and finishing. Then you allocate IT's total costs, its own costs, plus the share it got from HR, just to assembly and finishing. Once a department's costs are allocated out, no costs are allocated back to it.
Creates sort of cascade effect.
Exactly. It provides a more refined allocation than the direct method, reflecting some of those interdepartmental services.
Fascinating. So different systems for product types, ABC for overhead accuracy, methods for service costs. What about when multiple different products come out of the same production process? How do you split the costs before they become separate things?
Ah, good question. If we connect this to the bigger picture, this leads us directly to joint product and byproduct costing.
Joint products, like from one source.
Exactly. Think about the meatpacking industry again. One input, a steer, results in many different outputs. Various cuts of meat, hides, stuff for pet food.
Okay, those are joint products. What are byproducts?
Joint products are two or more main products generated simultaneously from a common input and process, usually with significant sales value. Byproducts are minor products that come out of the same process but have a much smaller value compared to the main products. Maybe some ingredients for glue derived from processing the steer.
Got it. Main outputs versus minor incidental ones.
And the key point in the process is the split-off point. That's the exact moment where these joint products become separately identifiable.
So before that point, all the costs are shared.
Right. Costs incurred up to the split-off point are joint costs. Any costs needed to process a product further after split-off are called separable costs.
That gasoline example was really interesting, how it went from scrap to byproduct to joint product.
Yeah. It perfectly shows how market demand and value can completely change how we classify and account for these outputs. What was once waste became incredibly valuable.
So how do you allocate those joint costs incurred before the split-off?
There are a few common methods. One simple way is based on unit volume relationships. You just allocate the joint costs based on the physical quantity of each product produced. If you get 10,000 gallons of product A and 20,000 of product B.
A gets a third, B gets 2/3 of the joint cost.
Simple as that, but maybe not reflective of value.
So what's a better way?
Often, companies use relative net realizable values, NRV. This method allocates joint costs based on the product's estimated market value.
How does that work?
You figure out the final selling price of each joint product, subtract any separable costs needed after the split-off point to get it ready for sale, and that gives you the NRV at split-off. You then allocate the joint costs in proportion to these NRVs.
So the more valuable products get assigned a bigger share of the pre-split-off costs.
Exactly. It matches the cost allocation better with the revenue-generating ability of the products.
And what about the revenue from those minor byproducts?
Good question. There are two main ways to handle byproduct revenue. You can either use it to reduce the joint costs allocated to the main products.
Making the main products look cheaper.
Yes. Or you can simply treat the byproduct revenue as miscellaneous income or other revenue on the income statement, like a small bonus. The method often depends on the significance of the byproduct's value.
Performance measurement and driving success.
Okay, understanding costs is obviously critical, but that's only half the battle, right? How do companies know if they're actually, winning?
Yeah.
What measures did they use to evaluate performance beyond just the bottom line profit?
That's a profoundly important question. Because it's not just about counting the beans, it's about motivating the right behaviors throughout the entire organization. Performance measures work best when they provide feedback that connects to people's actions, their interests.
Creating a link between the measure, the goal, and maybe an incentive.
Exactly. That linkage is key. And these measures can be financial, like profit margins, but also, importantly, non-financial.
So how do they set targets? How do they know what good looks like?
And a really common strategy is benchmarking. This involves measuring your own processes, products, services against the best out there.
Against competitors.
That's external benchmarking, yeah. Comparing yourself to industry leaders.
Wow.
A key measure here is productivity, the ratio of outputs to inputs.
Getting more out with less in.
Essentially, you can look at total factor productivity, TFP, which compares output to the cost of all inputs, a very broad view. But more often, companies use partial productivity ratios, PPRs. These look at output relative to one specific input, like the garden furnishings example, how many sculptures they produce per pound of plastic.
Higher ratio means better efficiency with that specific resource.
Right. Very useful for targeting specific areas for improvement.
So that's comparing externally. Can you benchmark internally?
Absolutely. That's internal benchmarking, finding and replicating the best practices within your own organization. Maybe one plant is much more efficient than another. Why?
And what tools help with that internal view?
There's some great visual tools. Control charts are one. These are graphs that plot actual results over time, say defects per batch against statistically determined upper and lower control limits.
So you can see if a process is stable or going out of whack.
Exactly. It helps distinguish normal variation from potential problems needing investigation. Even if all points are within limits, a clear trend upwards might signal an issue brewing.
Okay, control charts track things over time. What else?
Pareto diagrams. These are fantastic for identifying the most frequent problems. It's based on the Pareto principle, the idea that roughly 80% of problems often come from 20% of causes.
The vital few.
Right. A Pareto chart lines up defect types from highest frequency to lowest. It visually shows you where to focus your efforts for the biggest impact. Maybe fixing just 3 types of defects eliminates 75% of all quality issues.
Smart way to prioritize. And once you know the main problems.
Then you might use a cause and effect diagram, also called a fishbone or Ishikawa diagram.
Fishbone?
Yeah, it looks a bit like a fish skeleton. The head is a problem or effect, high defect rate, and the bones branching off represent potential categories of causes like machinery, methods, materials, manpower, measurement, environment.
And smaller bones for specific causes within each category, like incorrect machine settings under machinery.
Exactly. It's a structured brainstorming tool to dig into the root causes after the Pareto chart tells you what the biggest problems are.
So it's not just about profit numbers. These operational and quality measures give a different view.
A much richer picture. Definitely. And there are other crucial non-financial measures focusing on customers and employees.
Like what?
Well, customer retention rate, CRR, is huge, because getting new customers is usually way more expensive than keeping the ones you have. CRR tracks the percentage of customers who stay with you period over period.
And the opposite is churn rate, how many you lose.
Right, also critical to watch. Similarly, employee turnover rate, ETR. Losing experienced people is costly recruitment, training, lost knowledge. ETR measures the rate at which employees leave.
High turnover is usually a bad sign.
Generally, yes. Then you have things like labor productivity rate, LPR, total output divided by total labor hours. Higher is better. Or in customer service, ticket response time. How quickly do you respond to a customer inquiry? Reducing that time improves satisfaction.
These seem much more operational, day-to-day focused.
They are, and they often act as leading indicators for future financial performance. Happy customers and productive employees usually lead to better profits down the road.
You also mentioned non-GAAP measures. What are those about?
Right. GAAP is generally accepted accounting principles, the standard rules for financial reporting. But sometimes those rules include things that can obscure the underlying operating performance, like one-off gains or losses, or non-cash charges like amortization.
So non-GAAP adjusts for those.
Exactly. Companies use measures like EBITDA earnings before interest, taxes, depreciation, and amortization, or free cash flow, or core earnings, to give investors what they feel is a clearer picture of ongoing operational profitability and cash generation.
A kind of adjusted view of performance.
Precisely. Useful for comparison, but you need to understand what adjustments were made.
So with all these different measures, financial, non-financial, GAAP, non-GAAP, how do companies pull it all together into a coherent picture? Seems like a lot to track.
It can be. That's where frameworks like the balanced scorecard become incredibly valuable. But first, companies often organize themselves into responsibility segments or strategic business units, SBUs.
Like different divisions or departments?
Yeah, and these SBUs are often classified by their main financial goal. A cost SBU manager is responsible for minimizing costs. A revenue SBU manager focuses on maximizing sales. A profit SBU manager is accountable for both revenues and costs. And an investment SBU manager is responsible for profits relative to the assets they manage.
Different levels of responsibility.
Right. And within profit SBUs particularly, they often use contribution reporting.
Contribution. We heard that term with CVP analysis.
Same idea. Contribution reporting focuses on the contribution margin, which is sales revenue minus all variable costs. This shows what's left over to cover fixed costs and contribute to profit.
Okay.
Then you might calculate the controllable margin. That's the contribution margin minus any controllable fixed costs. Costs that the SBU manager can actually influence within that period, like local advertising or certain salaries. Costs they can't control, like allocated corporate overhead, are subtracted later.
So it helps evaluate the manager based on what they can actually manage.
Exactly. It separates controllable performance from allocated costs they can't influence.
Got it. Now, the balanced scorecard, you said it pulls everything together.
Yes, it's a really powerful strategic management tool. It moves beyond just financial measures to give a more holistic or balanced view of performance.
How does it do that?
It gathers information and measures performance across 4 key perspectives, asking, to achieve our vision, how should we look to?
Okay, what are the 4 perspectives?
1. Financial. How to look to shareholders. Profitability, growth, shareholder value. Classic financial metrics.
2.
2. Customer. How do customers see us? Market share, customer satisfaction, retention, brand image.
3.
3. Internal business processes. What must we excel at? Efficiency, quality, productivity, cycle times in our core operations.
And 4.
4. Learning and growth, sometimes called innovation and human resource development.
Yeah.
How can we continue to improve and create value? Employee skills, morale, access to information, innovation capabilities.
So it connects strategy across finance, customers, operations, and future capability.
Precisely. The idea is that success in the learning growth, internal process, and customer perspectives should lead to improved financial results. It links leading indicators, non-financial, to lagging indicators, financial.
That Instafab example showed how a goal like capturing market share, financial, linked to tactics like expand services, internal, measured by percent sales from new products, learning growth.
Exactly. It forces companies to think about how different strategic objectives connect and what specific measures will track progress across all dimensions.
Very comprehensive. One last area in performance, cost of quality. What's that about?
Right. This framework looks at the costs associated with achieving good quality and the costs resulting from poor quality.
So costs of getting it right versus costs of getting it wrong.
Essentially, yes. We split them into conformance costs and non-conformance costs.
Conformance costs are the getting it right costs.
Yes, these are proactive. They include prevention costs, money straight to prevent defects from occurring in the first place. Think employee training, quality engineering, robust supplier evaluation, preventive maintenance.
Investing up front to avoid problems.
Exactly. The other conformance cost is appraisal costs. These are costs incurred to find defects before the product gets to the customer. Think testing, inspection, quality audits, lab maintenance.
Checking to make sure things are right before they go out the door.
Right, so prevention and appraisal are the costs of good quality.
The non-conformance costs must be the costs of bad quality.
Correct. These are reactive and often much larger and harder to fully quantify because they include opportunity costs. They split into 2 types.
Okay.
Internal failure costs are costs of defects found before the product ships. Things like rework, scrap, downtime caused by quality problems, retesting. Costs incurred because you failed internally.
Still costly, but at least the customer didn't see it.
Right. The really damaging ones are external failure costs. These are costs of defects found after the product reaches the customer.
Oh boy, like warranty claims.
Warranty costs, yes. But also returns, handling complaints, liability lawsuits, product recalls, and the biggest, often hidden cost, lost sales and damage to reputation from unhappy customers.
That could be huge.
Absolutely. And what quality reporting often shows is an inverse relationship.
Meaning?
If you invest more in prevention and appraisal,
Oh.
conformance costs, you should see a significant decrease in internal and external failure costs, non-conformance costs. That GPI example showed exactly that spending more upfront on quality saved them much more in failure costs later, improving overall profit.
So investing in quality pays off.
That's the fundamental message, yes.
Charting the future. Planning and forecasting.
Okay, tracking costs, measuring performance. That gives us a great picture of where we are and how we did. But how do companies look ahead? How do they plan for what's next and build that roadmap?
Right. If we connect this to the bigger picture, planning is absolutely fundamental. It's how strategy gets translated into concrete action. And the core tool for that short to medium term planning is budgeting.
Budgeting. Everyone's favorite topic.
Huh. Maybe not, but it's essential. Budgeting is really operational and tactical planning, usually looking ahead, say, up to 18 months. It turns those high-level strategic goals into detailed, period-specific financial and operational plans.
So how does it work? Who puts the budget together?
Well, effective budgeting needs clear budget policies. This often involves broad management participation, maybe through a dedicated budget committee representing different departments. And crucially, it needs clear guidelines and support from top management, ensuring the budget aligns with the company's overall direction.
Makes sense. Needs buy-in and direction. Budgets use standards, right? We talked about those briefly.
Yes, absolutely. Standards are essentially per unit budgets for costs like materials or labor. How much should it cost to make one unit?
And there are different types of standards. Ideal versus attainable.
Right. Ideal standards assume perfect efficiency. No waste, no downtime, peak performance always. They can be good targets for continuous improvement initiatives like total quality management, but
Maybe demotivating if people feel they're impossible to reach.
exactly. That's why many companies use currently attainable standards. These build in allowances for normal, expected inefficiencies, normal spoilage, expected downtime, reasonable effort levels. They're seen as tough but fair, which helps foster acceptance and motivation.
Okay, that makes sense. And how are they set? Top down or bottom up?
That's the authoritative versus participative distinction. Authoritative standards are set entirely by management. It's quick, ensures consistency, but
Might not get buy-in from the people who have to meet them.
right. Participative standards, on the other hand, involve input from the managers and employees who are actually responsible for meeting the standards. It takes longer, requires more negotiation, but generally leads to much greater acceptance, ownership, and motivation.
Trade-offs there. So all these individual standards and plans roll up into...
The master budget. Think of it as the grand plan, the annual business plan. It's a comprehensive, coordinated set of all the individual budgets, covering all aspects of operations and finance for the short term.
What are the main parts of a master budget?
It usually has two main components. First, the operating budgets. These describe the income-generating activities, sales, production, materials, labor, overhead, selling, and administrative expenses. How are we going to run the business day to day?
Okay, the operational side and the second component.
The financial budgets. These focus on the financial implications of the operating plans. The main ones are the cash budget, the budgeted income statement, the budgeted balance sheet, and the budgeted statement of cash flows. Also, the capital expenditures budget.
So it flows from operations to the final financial picture.
Exactly. There's a logical flow. It all starts with the cornerstone.
Let me guess. The sales budget.
You got it. The sales budget, forecasting sales in units and dollars, is the absolute foundation. Almost every other budget depends on it.
Because it tells you how much you need to produce.
How much to produce, yes. That drives the production budget. The formula is usually budgeted sales units plus desired ending inventory units, beginning inventory units, units to produce.
Makes sense. Plan sales,
Yeah.
figure out inventory changes, no production needs.
Then the production budget drives the direct materials budget, how much material to buy and use, and the direct labor budget, how many labor hours are needed, what's the cost.
Okay, following the chain, what about overhead?
The factory overhead budget estimates all the indirect manufacturing costs, both variable, like indirect materials, some utilities, and fixed, like rent, depreciation, supervisor salaries. These are often applied to production based on a cost driver, like direct labor hours.
And all those production costs come together.
In the cost of goods manufactured and sold budget, it summarizes the direct materials, direct labor, and factory overhead expected to flow through production and eventually into cost of goods sold.
Phew, lots of budgets. What about non-manufacturing costs?
That's the selling and administrative S&A expense budget. This covers everything outside the factory sales commissions, advertising delivery costs, executive salaries, accounting department costs, office depreciation, etc. Some are variable, some are fixed.
Okay, that covers the operating side and leads to a budgeted income statement. What about cash?
The cash budget. Arguably one of the most critical pieces. Profitability is great, but cash is king, right? This budget projects cash inflows and outflows in detail.
Why is it so important?
Because a company can be profitable on paper but still run out of cash if collections are slow or payments are bunched up. The cash budget helps manage liquidity. It usually has 3 sections.
Which are?
cash available, beginning cash balance plus expected cash collections from sales, maybe loan proceeds, cash disbursements, expected payments for materials, labor, overhead, S&A expenses, loan repayments, asset purchases. Note you exclude non-cash expenses like depreciation here, financing. Shows expected borrowings needed if there's a shortfall, or repayments investments if there's excess cash. Maintaining a minimum cash balance is often a key target.
So tracks every dollar in and out and plans for borrowing if needed.
Precisely. That Betcon example showed how they projected collections based on past patterns, timed their payments, and figured out if they'd need their line of credit.
Okay. And the final output of all this?
The pro forma financial statements. Your budgeted income statement, balance sheet, and statement of cash flows. They show the expected financial position and results if all the budget plans are achieved.
A complete forward-looking picture. You also mentioned capital budgets.
Right. Those are separate but related. They deal with planned long-term investments, buying new machinery, building a new plant, launching a major new product line. These decisions often span multiple years, unlike the typically annual operating budget.
Got it. Now, budgets are usually based on one expected level of activity, right? What if sales are higher or lower?
Great point. That's where flexible budgeting comes in. A static budget is prepared for just one level of activity. A flexible budget is designed to show expected revenues and costs at different levels of activity within the relevant range.
How is that helpful?
It's incredibly useful for performance evaluation. If actual sales were higher than the static budget, you can't fairly compare actual costs to the static budget costs. The flexible budget shows what costs should have been at the actual level of sales or production achieved.
So you can compare actual results to a relevant benchmark.
Exactly. It helps separate volume effects from efficiency effects. Did costs go up just because volume went up expected? Or were we inefficient a problem? The Flixomatic example showed how income would change at different activity levels based on variable costs changing and fixed costs staying the same.
A much more dynamic tool for control. Okay, so flexible budgets help adapt. But how do companies actively predict different future outcomes? Explore those what-ifs.
This is where projection and forecasting techniques become invaluable. One common one is sensitivity analysis, often called what-if analysis.
Playing with the numbers.
Kind of. You systematically change key assumptions or variables like sales price, variable costs, or sales volume to see how sensitive the final outcome, like operating income, is to those changes. The Besser Company example showed the impact on income if sales were 10% higher or lower than expected. It highlights key risks.
Okay, testing one variable at a time. What if multiple things might change?
Then you might use scenario analysis. Here, you build several different plausible future scenarios, maybe an optimistic case, a pessimistic case, and a most likely case based on different combinations of assumptions about the economy, competitors, etc.
Like the Ridge Company example, projecting sales under boom, recession, or steady conditions.
Exactly. You can even assign probabilities to each scenario to calculate a weighted average expected outcome. It gives a richer view of potential futures than just changing one variable.
More complex, but maybe more realistic. What about statistical methods?
Absolutely. Regression analysis is a powerful tool for studying the relationship between variables. Simple linear regression, for example, tries to explain one dependent variable, like total manufacturing cost Y, as a function of one independent variable, like production units X.
Finding the line of best fit.
Essentially, yes. It estimates the fixed component, the A or intercept, and the variable cost per unit, the blocker or slope. So you get a formula like total cost, fixed cost, plus variable cost per unit production units.
How do you know if the regression is any good?
We use statistical measures. The coefficient of correlation R tells you the strength and direction of the linear relationship. It ranges from -1, perfect inverse, to +1, perfect positive. 0 means no linear correlation.
Okay, measures strength. What else?
The coefficient of determination are really important. It tells you the proportion of the change in the dependent variable cost that is explained by the change in the independent variable volume. An R of 0.81, like in the Raxan example, means 81% of the variation in total cost is explained by changes in volume.
So a higher R means the model fits the data better. Volume is a good predictor of cost.
Exactly. It measures the goodness of fit.
Regression sounds powerful, but maybe complex. Is there a simpler way to estimate fixed and variable costs?
Yes, the high-low method. It's much simpler, though less precise than regression.
High-low, how does that work?
You just take 2 data points, The period with the highest activity level and its associated total cost, and the period with the lowest activity level and its cost, ignoring any obvious outliers.
Okay, highest and lowest points. Then what?
You calculate the change in cost between those 2 points and divide it by the change in activity level. That gives you an estimate of the variable cost per unit. Then you can plug that back into either the high or low points total cost equation to solve for the estimated fixed costs.
A quick and dirty way to get a cost formula.
Pretty much. Useful for a rough estimate or when you don't have enough data for regression.
Interesting. What about the learning curve? That sounds different.
It is. It applies specifically to situations where labor is a major cost component, and the task is repetitive but complex enough that workers get significantly faster as they gain experience.
It's like assembling something intricate.
Exactly. The theory is that as cumulative production doubles, the cumulative average time per unit decreases by a constant percentage, the learning rate.
So if the learning curve is 80%, when production doubles, the average time per unit drops to 80% of what it was before.
Correct. The Jones production example showed how the average time and thus total time for 2, 4, and 8 units decreased predictably with a 70% learning curve. It's crucial for accurate labor budgeting and pricing in industries where it applies.
Fascinating effect. Okay, let's move to a big one. Cost, volume, profit, CVP analysis, also known as break-even analysis.
Yes, CVP or break-even analysis is fundamental. It helps managers understand the relationships between costs, sales volume, and profit. It forecasts profit at different activity levels and identifies the point where total revenue equals total cost, the break-even point.
What assumptions does it make?
It relies on several key assumptions. All costs can be neatly classified as either fixed or variable. Costs behave linearly within the relevant range. Volume is the only significant driver of cost changes. Selling prices are constant, and if there are multiple products, the sales mix remains constant.
So simplifying assumptions to make the analysis possible.
Exactly. Now, a critical concept within CVP, especially for internal decision-making, is the difference between the absorption approach and the contribution approach to income.
We touched on this. Absorption is GAAP.
Yes, absorption costing is required by GAAP for external reporting. It treats fixed manufacturing overhead as a product cost. This means some fixed overhead gets attached to inventory units.
So if you build inventory, some fixed cost stays on the balance sheet.
Right. The contribution approach, also called variable costing or direct costing, treats fixed manufacturing overhead as a period cost. It gets expensed entirely in the period it's incurred, regardless of production levels.
Why is that distinction important for CVP?
Because the contribution approach clearly separates fixed and variable costs. It highlights the contribution margin, sales revenue variable costs. This margin represents the amount available to cover fixed costs and then generate profit. It makes the relationship between volume and profit much clearer.
So contribution margin is key for CVP. How does the fixed overhead treatment affect reported income?
It's the key difference. If production is greater than sales, inventory increases. Absorption costing will generally report higher net income because some fixed overhead is deferred in inventory.
Okay. And if sales are greater than production?
Then absorption costing income will be lower because fixed overhead from previous periods is released from inventory through cost of goods sold. If production equals sales, income is the same under both methods.
Got it. So variable costing income moves more directly with sales volume.
Yes, which is why managers often prefer it for internal analysis and CVP calculations. It avoids profit being influenced by inventory changes. But remember, it's not GAAP for external reporting.
Okay, so using that contribution margin approach, what can CVP tell us?
Lots of useful things. You can calculate the break-in point in units, total fixed cost contribution margin per unit, or in dollars, total fixed cost contribution margin ratio. That's the sales level needed to cover all costs.
Just to break even, zero profit.
Right. You can also calculate the required sales volume for a target profit. Just add the target pre-tax profit to the fixed costs in the numerator of the break-even formula.
So you know how much to sell to hit a specific profit goal.
Exactly. CVP also helps predict profits based on volume. Each unit sold above break-even adds its contribution margin per unit to profit, and even helps in setting selling prices if you know your costs and target profit at a specific volume.
And the margin of safety.
That's simply the amount by which current or budgeted sales exceed the break-even sales. It tells you how much sales could drop before you start making a loss. A cushion.
Very useful metrics for planning and risk assessment.
Absolutely. And finally, related to pricing and cost management, there's target costing.
How does that work? Sounds like you start with the cost.
Actually, it flips the traditional cost-plus pricing model. Target costing starts with the market price, what customers are willing to pay. Then, the company subtracts its desired profit margin from that market price.
And that gives you.
The target cost. That's the maximum allowable cost the company can incur to produce the product and still achieve its profit goal at the market price.
So the market dictates the cost you have to achieve.
Essentially, yes. It forces the company to focus intensely on cost reduction during the design and engineering phases. It might involve finding cheaper materials, simplifying the design, improving manufacturing efficiency, sometimes through methods like Kaizen costing, which focuses on continuous small improvements. The challenge is hitting that cost target without compromising quality too much.
Unlocking insights, financial statement analysis and variances.
Okay, we've planned, we've budgeted, we've costed. Now, how do companies take all that resulting financial data and really understand their current situation? And, crucially, how do they react when things don't go according to plan?
This is where analysis really comes into its own. A fundamental tool here is ratio analysis.
Ratios, like comparing numbers on the financial statements.
Exactly. Ratios are financial indicators that quantify relationships between different items on the income statement, balance sheet, or statement of cash flows. They're incredibly useful.
How so? What do they tell you?
They help you compare performance over time. Is the company improving? Compare the company to its competitors. How do they stack up? Or compare to industry averages. They provide context and a quick snapshot of financial health. Remember the simple rule. Changes in the numerator have a direct impact. Changes in the denominator have an inverse impact.
Okay, so what kinds of ratios are there?
They generally fall into logical categories. Profitability ratios measure how successfully the company generated profit during a period.
Like gross margin, profit margin, return on sales.
Yes. Also, return on assets, ROA. Return on equity, ROE. They tell you how effectively the company uses its sales, assets, or equity to generate profit. Generally, higher is better. The DuPont analysis breaks down ROA and ROE further to show what drives them.
Okay, profitability. What else?
Liquidity ratios. These measure the company's ability to meet its short-term obligations as they come due. Can they pay their upcoming bills?
Like the current ratio or the quick ratio asset test.
Exactly. They compare current assets to current liabilities. Healthy ratios suggest the company has enough liquid resources. Also in this category are turnover ratios. Accounts receivable turnover, inventory turnover.
They measure efficiency, how fast you collect cash or sell inventory.
Right. Higher turnover is generally better, meaning assets are being managed efficiently. We also look at days sales in receivables or days in inventory to see how long things are taking. Similarly, accounts payable turnover and days of payables.
Outstanding look at how quickly the company pays its own suppliers. The cash conversion cycle combines these to show how long cash is tied up in operations.
Got it. Liquidity is short-term health. What about long-term?
That's where solvency ratios come in. These measure the company's ability to meet its long-term obligations and the extent of its financial leverage, how much debt it uses.
Like debt to equity or the total debt ratio? Yes, and the equity multiplier. These show how much of the company's assets are financed by debt versus equity. Lower debt ratios generally indicate lower financial risk, providing more protection for long-term creditors and investors. Times interest earned shows how easily the company can cover its interest payments from operating earnings.
So solvency is about long-term stability and risk.
Correct. And finally, there are broader performance metrics. Some, like EBITDA, we mentioned earlier as non-GAAP measures, giving a view of operating performance before financing and tax effects. Others are more investor-focused.
Like earnings per share, EPS, or the price-to-earnings PE ratio.
Exactly. EPS shows profit allocated to each share of common stock. The PE ratio compares the stock price to EPS, giving a sense of market expectations. Dividend payout ratio shows how much profit is returned to shareholders. Asset turnover measures how efficiently assets generate sales.
So ratios give different perspectives: profitability, liquidity, solvency, performance.
Right. But remember, ratios has limitations. They depend on the quality of the accounting data. And one ratio alone doesn't tell the whole story. You need to look at trends over time, horizontal analysis, and compare items as percentages of a base, vertical analysis, for better context.
Makes sense. Need the bigger picture. Now, beyond these traditional ratios, how are companies using technology to dig deeper into all this data? It must be overwhelming.
Oh, absolutely. The evolution of data analysis has been transformative. First, data itself comes in different forms. Internal data from company systems, external data from outside, and critically, structured versus unstructured data.
Structured is like neat spreadsheets and databases.
Yes, highly organized, consistent format, easily searchable. Think customer records, sales transactions. Databases are often normalized to reduce redundancy and improve integrity, like that college scholarship example, organizing recruit info into linked tables.
And unstructured.
That's the messy stuff. Social media posts, emails, call center transcripts, videos, images, sensor data. Much harder to organize and search, but often contains incredibly rich insights.
So you gather all this data. Then what?
Then comes data transformation. This is vital. It's about cleaning, organizing, and preparing the data for analysis, ensuring completeness, integrating data from different sources, cleaning or scrubbing it.
Scrubbing, like removing headings, fixing errors.
Exactly. Dealing with missing values, correcting inconsistencies, like different spellings for the same thing, formatting dates or numbers correctly, encrypting sensitive data. You need reliable, usable data for analysis to mean anything.
Garbage in, garbage out otherwise?
Precisely. Once the data is ready, you get analytic outputs, often in the form of visualizations and reports. These are critical for actually seeing the patterns and insights.
Making the data understandable.
Right. And choosing the right visualization is key. Pie charts for proportions, scatter plots for relationships, line charts for trends. Using appropriate scaling on axes is crucial, starting a y-axis at 0, for instance, to avoid misleading comparisons. Using color effectively, highlighting key areas ethically.
So the visual tells a story. How do specific analyses use visuals?
Well, regression analysis uses scatter plots with the regression line to show the relationship. Variance analysis might use bullet charts visually comparing actual results to budget targets, showing over-under performance clearly.
Like seeing actual cost of goods sold versus the budgeted amount on one bar.
Exactly. Period-over-period analysis often uses bar or column charts to compare values across time, making differences jump out. Classification might use scatter plots or tree maps to group data points into categories, like visualizing sales patterns by state. And trend analysis heavily relies on line charts to show how metrics evolve over time, helping spot shifts or inconsistencies.
So data visualization makes complex data intuitive.
When done well, yes. And data analytics itself has different levels, asking different questions.
Levels.
Yeah, 4 main types. Descriptive analytics asks what happened. It summarizes past data basic reports, summary statistics, sorting data like aging accounts receivable.
Just describing the past.
Then diagnostic analytics asks, why did it happen? This involves drilling down, finding correlations, maybe using cluster analysis, like figuring out why accounts payable spiked by looking at specific supplier patterns.
Digging for root causes.
Predictive analytics asks, what will happen? This uses historical data and statistical models like regression or decision trees to forecast future outcomes, like the power company predicting outages based on weather forecasts.
Using the past to predict the future.
And finally, prescriptive analytics asks, what should happen? This is the most advanced level, often using AI, machine learning, or simulation models to recommend optimal actions, like modeling tax outcomes for international expansion to find the best location.
Guiding future decisions. So descriptive, diagnostic, predictive, prescriptive.
Right, and these analytics are used everywhere. Customer marketing insights, improving operations, managing risk and compliance, financial planning, auditing, tax planning. It touches every function.
It's incredible how central data analysis has become. So this brings us back to when things don't go according to plan. After all the planning and analysis, actual results differ. How do companies pinpoint exactly where the deviations occurred?
This is where it gets really interesting and incredibly useful for control. Variance analysis, especially when used with a standard costing system.
Standard costing, using those predetermined costs we talked about.
Exactly. Setting standard costs for materials, labor, and overhead provides benchmarks. Then, variances are simply the differences between the actual costs incurred and those standard costs that should have been incurred for the actual level of production achieved.
Differences between actual and standard.
Right. We label variances as favorable, actual cost lower than standard, or unfavorable, actual cost higher than standard. We might also consider if a variance was controllable by a specific manager or not. We typically analyze variances for all major product costs.
So let's break it down. Direct materials and direct labor.
For both direct materials and direct labor, we usually calculate 2 main variances. First is the price variance, or rate variance for labor.
Price variance. Did we pay more or less than standard?
Exactly. The formula is actual quantity purchased or hours worked times actual price rate minus standard price rate. It isolates the impact of paying a different price or rate than planned. If Lucy Inc. got a deal on materials, that's a favorable DM price variance. If they paid workers more per hour than standard, that's an unfavorable DL rate variance.
Okay, isolates the price rate difference. What's the second
The
variance?
quantity variance, or efficiency variance for labor. This measures whether more or less material or labor was used than the standard allowed for the actual output achieved.
So were we efficient with resources?
Right, the formula is standard price rate times actual quantity used hours worked minus standard quantity hours allowed for actual production. If Lucy Inc. used more fabric than standard to make the couches, that's an unfavorable DM quantity variance. If workers finish the job faster than the standard time, that's a favorable DL efficiency variance.
So price rate tells you about cost per input unit, and quantity efficiency tells you about how many input units were used. Very clear separation.
Precisely. It helps pinpoint whether the issue was procurement wages or operational efficiency on the factory floor.
Okay. Materials and labor seem manageable. What about manufacturing overhead variances? They often seem more complicated.
They can be, because overhead includes both fixed and variable costs, and it's applied indirectly. First, we look at the overall difference. Was overhead underapplied, actual overhead applied, overhead unfavorable, or overapplied, actual applied favorable?
Okay, the total difference, but you can break that down further.
Yes, often into 4 specific variances for more detailed insight, especially useful with flexible budgeting. 2 for variable overhead, 2 for fixed overhead.
Let's take variable overhead, VOH first.
Okay, first is the VOH rate variance, sometimes called the VOH spending variance. Formula: actual hours worked times actual VOH rate minus standard VOH rate. It asks, did we spend more or less per hour or other activity base on variable items like indirect materials or power than we expected?
Similar to the labor rate variance, but for variable overhead items.
Exactly. The second VOH variance is the VOH efficiency variance. Formula: standard VOH rate times actual hours worked minus standard hours allowed for actual production. This measures the efficiency of the activity base used to apply VOH. If VOH is applied based on direct labor hours and workers are inefficient, took too many hours, this variance will be unfavorable, even if the spending per hour was okay.
So it links VOH cost to the efficiency of the driver, like labor hours.
Correct. Now for fixed overhead, FOH.
Okay, the last two variances.
First is the FOH budget variance, sometimes called the FOH spending variance. This one is simple: actual fixed overhead minus budgeted fixed overhead. Did we spend more or less on fixed items like rent or salaries than we budgeted for the period?
Straight comparison of actual spending to the budget.
Yes. The final one is the FOH volume variance. This one is unique to fixed overhead and often misunderstood. It arises only because the actual production volume achieved differs from the volume level used to set the predetermined standard fixed overhead rate.
How does that work?
Formula: budgeted fixed overhead minus standard fixed overhead cost allocated to production, which is actual production units standard FOH rate per unit. If you produce fewer units than budgeted, you haven't absorbed all the budgeted fixed overhead into products, resulting in an unfavorable volume variance. It basically measures the cost of not utilizing your plant capacity as planned in the budget. It's not really about spending, it's about utilization.
So it relates to whether you produced more or less than planned, affecting how fixed costs were spread.
Exactly. That Lucy Inc. example walked through all 4. They had unfavorable VOH rate, spent more per hour; favorable VOH efficiency, used fewer hours than standard; favorable FOH budget, spent less on fixed items than budgeted; and unfavorable FOH volume, produced fewer units than budgeted. Understanding all 4 gives a complete overhead picture.
Very detailed breakdown. Are there variances for sales, too?
Yes, absolutely. Sales variances help evaluate the effectiveness of marketing and sales efforts compared to the budget or plan.
How do those work?
2 main ones typically: the sales price variance, actual quantity sold times, actual selling price minus standard budgeted selling price. Did we get the price we expected for the units we sold? If Cascade Company sold for less than planned, that's an unfavorable variance.
Makes sense. And then the other one?
The sales volume variance, standard budgeted selling price or contribution margin times actual quantity sold minus standard budgeted quantity sold. This isolates the impact of selling more or fewer units than budgeted, valued at the standard price or margin. If Cascade sold more units than planned, that's a favorable volume variance.
So price effect versus quantity effect on revenue or profit.
Right. And it gets even more interesting if a company sells multiple products with different profit margins. Then you can calculate a sales mix variance.
Sales mix. How does that work?
This measures the effect of the actual proportion of products sold differing from the budgeted proportion. Imagine Neostar selling high-margin Novas and low-margin Sunbeams. Even if they sell the total budgeted number of units, if they sell proportionally more Sunbeams, low margin, and fewer Novas, high margin, than planned,
Their overall profit will be lower than budgeted, even though total volume was met.
Exactly. That would result in an unfavorable sales mix variance. It shows that what you sell can be just as important as how much you sell when products have different profitability. Outro.
Wow. Okay, that was a truly comprehensive deep dive from the tiniest cost details all the way up to big strategic planning and analysis. It really shows how these tools give businesses the clarity they need.
It really does. And if we connect this back to the bigger picture, what we've explored today shows that, understanding these core accounting and management principles isn't just for the finance folks.
No, definitely not.
It's key to understanding the basic mechanics of any organization. It empowers you, the listener, to ask sharper questions, whether you're an investor, an employee, a manager, or just curious, to spot those crucial insights.
Absolutely. So the next time you're looking at a company's results, or even just thinking about how a new gadget gets made and priced, maybe think about some of these things. Like, how are they figuring out their cost objects? What are the real targets of their cost tracking?
Are they using something sophisticated like activity-based costing to get accurate overhead allocation,
Yeah.
or just smearing costs based on volume?
Yeah. And what about performance? What non-financial metrics are they tracking? Customer retention, employee skills, things that might predict future success better than last quarter's profit.
And how are they using data visualization and variance analysis? Are they just reporting numbers, or are they truly using the data to learn and adapt when things inevitably go off plan?
So many layers. What insight from today's deep dive stands out most to you? What should someone really take away and use to ask a sharper question next time?
That's a tough one. Maybe the power of variance analysis combined with flexible budgeting, understanding not just that you missed the budget, but precisely why was it price, efficiency, volume, mix. That level of detail is where real control comes from.
That's a great takeaway, knowing the why behind the numbers. Well, thank you for joining us on the deep dive. We really hope this exploration gives you a powerful shortcut to being well informed about the financial engine of business and maybe fuels your curiosity for what's next.